eToro Copytrading Basics.
The risk score is a very high-profile metric on eToro. A mistake many copiers make is to think that this is the only indication of risk they need to make an informed decision on a popular investor. Well, it's not. If you're anything like me, when I first joined eToro, I believed the risk score algorithm was showing me how much risk there is in copying this trader as of today, based on what he owns today and its price today. But my assumptions were incorrect. It doesn't really do any of that. Learned voices caution that it is better to view the eToro risk score as a starting point for assessing risk, not the end point. Firstly, look at how it's presented. Each coloured bar represents the average monthly risk score. The thin horizontal lines indicate the maximum monthly risk score. So that's the first thing to ask. Which matters more to me? A general idea of how risky this PI is? Or what is the most extreme behaviour causing the risk score to spike each month? Imagine you're going to walk a high cliff path along a sheer drop. At the start there's a sign indicating danger. Would it be more helpful to you if it told you A. The average distance from the crumbling edge is a safe 4 meters, or B. There's one section dangerously close to the crumbling cliff edge? So don't ignore the maximum risk score. For my money, it's likely to be more important to you than the average risk score. In investing, risk is often defined as the risk of the permanent loss of money, and I think that is what most of us would agree that we mean when we use the word risk. The eToro risk score, however, is more of an indicator of volatility, prices moving up and down. This is what eToro say they factor into the risk score. The total allocation of the user's portfolio. This includes how much cash they have on hand and how their position sizes are, the leverage they are using, the overall volatility of the markets they trade, and the correlation between them. The reality is, it's mostly an indicator of volatility. When the market drops suddenly and significantly, everyone's risk score shoots up. Why? Because the algorithm detects this movement as an increase in volatility. This can be a bit strange. Imagine you want to buy an entire business that you're confident will make $1 million every year for the next 5 years. There is always going to be some risk in this investment. You might be wrong. So if it costs you $2 million, that's a good deal, right? You make your money back in 2 years. Imagine the price then drops to $1 million. But nothing else has changed. The risk of that investment has just been reduced. You'll make your money back in 1 year. However, the risk score would consider that investment to now be more risky because of the volatility that the price displayed. It dropped by 50%. It would be considered a more volatile asset. So really we're talking more about volatility than real-world risk. Also, the risk score is based on the proportions of the invested column, not their current portfolio, the value column. So that's one thing to remember when looking at any PI's portfolio, since the current reality may be very different from the invested column. This PI, for example, used to have an Ethereum position of 4.82% in their portfolio, but it has now grown to 17.97%. Yet it is the 4.82% position that factors into their risk score. So in a sense, the risk score doesn't reflect what the PI's portfolio looks like today. So it's pretty clear that my assumptions about the eToro risk score were way off. The eToro risk score is a handy starting point when assessing risk. It gives you an idea of the volatility this PI's portfolio might experience. So that is helpful. While volatility certainly is an essential element of risk, it is merely a contributor. There's more work to do when you're trying to assess how risky a popular investor might be. In addition to looking at the questions that the algorithm includes, you could start with, does the PI show drawdown amounts that wipe out several months of gain? Does the PI's line chart show sudden steep drops and rises that are not visible in the bar chart? Is there a regular or significant difference between max and average risk score? Is the PI sticking to his guns re his investing style, or switching styles with the wind? Is the PI maintaining a large cash balance just to limit his otherwise risky portfolio? Is the PI investing in one thing using a variety of similar instruments to, quotes, trick the risk score? Is the PI being, quotes, creative with how they present their performance stats? Does the PI maintain clear quality communications with copiers? Do they answer difficult questions? And do the value column numbers vary greatly from the invested column, which results in an indication of greater risk to you? As you can see, this is a much bigger issue than can be dealt with in a quick video, but hopefully this is an informative starting point for you. Those are the basics. There's a little more to it than that. A more detailed video is available for those who copy me.